Imagine walking into a bank with like $1 million in cold, hard cash, asking for just a basic standard mortgage and getting completely denied because the computer doesn't know who you are.
Yeah, just flat out rejected at the door.
Exactly.
Yeah.
I mean, in 2026, human trustworthiness means absolutely nothing to the financial system. You can look a loan officer right in the eye and shake their hand. But if your digital footprint is, sin or damaged, that heavy steel door just stays shut.
It really is the ultimate automated gatekeeper. The financial industry doesn't evaluate your character anymore. It evaluates this cold, calculated, three-digit mathematical output. And standing in front of that gate is incredibly frustrating when you don't actually understand the algorithmic math governing your own financial life.
Which is exactly why we were pulling this apart today. Welcome to this deep dive. Our mission here is to serve as your ultimate shortcut to navigating the credit system without feeling overwhelmed. We are taking on the strategic mastery of, building, fixing, and maintaining your credit in 2026.
And crucially, how to generate the actual cash flow you need to fund that entire journey.
Right, because you need fuel for the engine. And we have an incredible stack of sources for you today to figure this out. We're pulling from institutional guides from the Consumer Financial Protection Bureau, Experian, SoFi, and First Card. We also have this great university breakdown of FICO scores from Pepperdine, insights from an AI credit building platform guide called creditbooster.ai, and we're breaking down a 2026 strategy video on hidden income streams.
The diverse nature of these sources really highlights that credit isn't just a single topic. It's an intersection of behavioral psychology, data architecture, and personal cash flow. You cannot optimize a system until you understand the underlying mathematics governing it.
Okay, let's unpack this. We're talking about the FICO score, created by the FAIR, Isaac Company. Looking at the Pepperdine University breakdown, this score ranges from 300 on the low end to 850 at the top. And the matrix is divided into 5 specific algorithmic buckets.
Right, 5 distinct chunks of data.
So 35% is your payment history. 30% is amounts owed, which is your utilization ratio. 15% is the length of your credit history. 10% is new credit. And the final 10% is your credit mix, meaning the types of credit you use. But looking at those percentages, I have to challenge the logic here.
Sure.
Why is past behavior, that massive 35%, chunk weighted so heavily? Like if I get a massive promotion today and double my salary, shouldn't the algorithm care about my new capacity to pay rather than a $20 minimum payment I made 18 months ago?
What's fascinating here is the pure statistical reality of human behavior that the FAIR Isaac Company models are actually built upon. Through decades of data analysis, lenders have found that a higher income does not mathematically correlate with a willingness to prioritize a debt obligation.
Wait, really?
It doesn't.
No, not at all. Someone making $500,000 a year who constantly pays late is actually a much higher risk of default than someone making $50,000 a year who has never missed a payment in a decade.
Oh, wow. Yeah, the algorithm heavily weights payment history because it proves you respect the structural obligation of the debt itself, entirely independent of your cash flow in any given moment. It's a behavioral risk model. It's not a wealth indicator.
So every single action you take, every card you open, every bill you pay is just a targeted strike on one of these 5 specific buckets, like a financial GPA. But this brings up the classic paradox of the system, right?
You need credit to get credit.
Exactly. If you are starting from absolute zero or you're trying to climb out of a sub 500 hole, how do you even get points on the board?
Well, you utilize the dedicated on-ramps. These are financial products engineered specifically to let unproven borrowers inject data into the system. The SoFi and creditbooster.a sources point heavily towards secured credit cards as the primary engine for this.
And we should clarify, we aren't talking about student cards here.
Yeah, definitely not. Student cards rely on college enrollment as a proxy for future earning potential. We are talking about utilizing a refundable cash deposit to literally buy your way into the data stream, usually starting around $200.
Wait, with a secured card, you're literally just borrowing your own money. How does that actually help you? I mean, tying up $200 or $300 when inflation is eating cash feels like a terrible capital allocation. You're basically paying a bank for the privilege of using your own money.
I get that, but you have to look at the mechanism operating under the hood. The bank is holding your $200 as collateral, which completely removes their risk. If you vanish tomorrow, they keep the deposit. They lose nothing.
Right, okay.
But the crucial mechanism is that the issuer reports your monthly activity to the 3 major credit bureaus, Equifax, Experian, and TransUnion. Those are the centralized databases that store your financial footprint. By using a secured card, you are generating that massive 35% payment history metric on a monthly basis without the bank taking any gamble on you. You're manufacturing trust data.
That makes a lot of sense. And the 2026 marketplace for these on-ramps is incredibly advanced compared to even like 5 years ago. The sources highlight the Discover It secured card. It has no annual fee, and they actually match your cash back in the first year.
Yeah, the rewards are great, but the real leverage is their graduation algorithm.
The automated review.
Exactly. The graduation mechanic is entirely automated now. At month 7, Discover's internal system actively scans your file. It looks for 0 missed payments and low utilization. If the math checks out, the algorithm automatically converts the account to an unsecured line.
And you get your money back.
Right. It refunds your original deposit directly to your bank account, all while leaving that perfect credit history intact.
That's huge. Now, the sources also point to the OpenSky Plus Visa for a very specific edge case. This card requires a slightly higher minimum deposit of $300, but there's absolutely no hard inquiry.
Which is vital for a lot of people.
Yeah, and just to define that for you listening, a hard inquiry happens when a lender pulls your full credit file to make a decision, which leaves a permanent timestamp on your report that you sought new credit. Too many of those drag your score down. So the OpenSky route is a guaranteed on-ramp for someone who wants to completely avoid a hard pull.
It is an essential tool for someone whose file is so damaged that a traditional secured card application might still face rejection. And we should probably dispel a persistent myth the sources flagged regarding premium issuers.
The Amex myth.
Yes. People frequently search for an American Express secured card. Amex does not offer a traditional secured product in the U.S. market. Their business model relies on seasoned files. You have to use tools like Discover or OpenSky to build your behavioral data into the fair to good range first, and only then do you apply for those premium products.
But look, not everyone wants the temptation of plastic in their wallet, right? Having a revolving line of credit can be dangerous if you struggle with impulse control. So how do you establish that 35% payment history without opening a credit card?
The Experian and CFPB guides outline these really powerful alternative architectures. The most mechanical of these is the Credit Builder loan.
Here's where it gets really interesting, because a credit builder loan operates completely in reverse. Normally, a bank hands you a lump sum and you pay it back. With a credit builder loan, a lender, usually a local credit union, takes the loan amount, say $500, and locks it away in a secured savings account.
You do not have access to the funds.
Right. You can't touch it. You make small monthly payments on it, usually for 6 to 24 months. The lender reports those successful payments to Equifax, Experian, and TransUnion. At the end of the term, they unlock the account and hand you the accumulated cash. It is essentially a forced savings account with a credit-boosting side effect.
It forces disciplined saving while, feeding the algorithmic beast. And mechanically, it also targets the 10% credit mix bucket in your FICO score. It adds an installment loan trade line to your profile.
And a trade line is just industry jargon for any account that appears on your credit report.
Correct. The algorithm likes to see that you can manage fixed installment payments alongside revolving credit cards.
Okay, so the second alternative strategy is rent reporting, which the first card source details. Historically, landlords just didn't pay the massive fees required to report data to the credit bureaus. You could pay your rent flawlessly for 10 years, and your credit score wouldn't reflect it at all.
It was a massive blind spot.
But now, platforms like Self, Pinata, and Kickoff act as data intermediaries. They link to your bank account, verify your rent payment, and report it to the bureaus as a standard installment trade line. You could literally see a 10 to 100-point score bump in under a year just by getting credit for a massive bill you were already paying.
It forces the bureaus to accept non-traditional data. But, and this is critical, the risk profile is symmetrical.
What do you mean by symmetrical?
If you use one of these intermediaries and pay your rent 30 days late, that late payment is hard-coded into your credit report just as fast as a missed credit card payment, and it will absolutely devastate your score.
Oh, wow. Okay, so high stakes, which perfectly transitions to the third alternative. The authorized user strategy, heavily known as piggybacking. You just get added to a family member's seasoned, perfect credit card account. Their 10 years of flawless payment history suddenly copy-pastes onto your blank credit report. Isn't that just a credit cheat code? Like for wealthy families to guarantee their kids get perfect credit without doing any actual work?
Well, it historically functioned exactly like a cheat code, but the fair Isaac Company recognized the artificial inflation happening in the market. The newer algorithmic models, specifically FICO 9 and FICO 10, actively dampen the impact of authorized user data.
So it doesn't work as well anymore.
It still provides a bump, sure, but modern underwriting systems increasingly isolate your primary accounts to see if you can manage risk in your own name. Furthermore, piggybacking carries a massive backfire effect.
Meaning you are chaining your financial identity to someone else's behavior. If the primary cardholder misses a payment, or if they have a medical emergency and max out the card, that negative data instantly attaches to your file. A thin credit profile will be completely destroyed by a parent's financial mistake.
Exactly. You surrender total control of your own data stream, which is why building primary data, even if you do it slowly, is structurally safer.
But let's look at the reality of funding this. Whether you need a $200 deposit for a Discover secured card, a $35 monthly plan for kickoff, or the cash to fund a credit builder loan building credit is a highly mechanical process, but cash is the fuel. If you're living paycheck to paycheck in 2026, where do you find that fuel?
The traditional advice of driving for a rideshare app or starting a massive dropshipping business that requires upfront capital, a reliable vehicle, or, significant audience building. We have to look at the hidden side hustles detailed in the YouTube source. Roles that require zero capital and operate entirely on pure skill exchange.
And the standout role here is the AI-generated content reviewer. Look, large language models are everywhere, but they still confidently hallucinate. They invent fake statistics, they write weird, disjointed marketing copy. Businesses cannot afford to publish that to their clients.
No, the reputational risk is way too high.
So they are hiring humans to review, fact-check, and correct this output in batches before it goes live. You don't need a degree in prompt engineering, you just need critical thinking, a laptop, and the ability to spot when an AI is lying.
Or consider the digital asset organizer. Small businesses accumulate years of messy, scattered files across various cloud storage platforms. They are drowning in unsearchable data. You get paid on a contract basis to go into their drives, categorize the metadata, build folder structures, and optimize their workflow.
It is tedious work for the business owner, but highly lucrative freelance work for someone who is organized. There's also the skill-based software coach, teaching someone one-on-one over Zoom how to automate their Excel sheets or build templates in Canva. And the data research assistant, where you simply pull public market data into a spreadsheet for local agencies. These are completely unglamorous, low-barrier services. You just trade your Tuesday evenings directly into income.
And if we connect this to the bigger picture, this specific type of flexible income is the exact engine needed to manipulate the FICO algorithm. Earning an extra $150 a week as a digital asset organizer means your secured card deposit is fully funded in a month. It means your credit builder loan payment never bounces.
It gives you the structural buffer to ensure you never carry a balance and trigger a 27% interest charge.
Right. But all of this hustle to build the score and fund the deposits means absolutely nothing if you trip over an invisible wire and blow it up. Once you have the score, you have to defend it. The Experian source outlines 8 common credit mistakes that destroy profiles overnight.
Okay, let's get into those.
The most mathematically destructive trap is misunderstanding how the algorithm views your balances. This hits the 30% utilization bucket.
I like to explain credit utilization using the RPM gauge on a car dashboard. You might have a sports car with a speedometer that goes up to 150 miles an hour. That is your total credit limit. But if you actually drive the car at 140 miles an hour every single day, the RPM gauge is redlining.
The engine is just screaming.
Right. The algorithm looks at you maxing out your available limit and assumes your financial engine is about to blow. The CFPB source gives a hard, fast rule. Keep your utilization strictly under 30%. If your limit is $1,000, your balance should never cross $300.
And we must clarify the mechanics of how that balance is reported. People often confuse their current balance with their statement balance.
Oh, this is a huge distinction.
Huge. The credit bureaus generally receive your balance data on the day your statement closes, not the day your payment is due. So if you max out your $1,000 card during the month, but pay it down to zero a week before the due date, it doesn't matter if the statement closed while the balance was at $950.
The algorithm saw you redlining and your score drops.
Exactly. You must pay down the balance before the statement period ends to manipulate the reported utilization.
Experian also warns against the danger of applying for multiple credit cards at once. Every application triggers that hard inquiry we defined earlier. If you apply for 5 cards in a week just to see what sticks, the algorithm reads that as desperate, distressed behavior.
It hits the 10% new credit bucket, and your score will plummet instantly.
That's brutal.
Long auto loan terms are another silent killer. People take 84-month car loans to get a lower monthly payment, completely ignoring the depreciation curve of the asset. You end up financially underwater, owing far more than the vehicle is worth.
And if the car is totaled, insurance only covers the current value. You are left with a massive deficiency balance you just cannot pay. The account goes to collections, and your pristine 35% payment history is ruined.
It wipes out all that hard work.
And the ultimate defense is monitoring. You cannot defend against what you cannot see. You have to check your reports manually at annualcreditreport.com or by calling 877-322-8228. And I noticed the CFPB specifically notes that federal law mandates you can get extra free reports outside the normal cycle if you were denied credit, a victim of fraud, unemployed, or on public welfare.
The CFPB enforces this mandate because those specific demographics are statistically at the highest risk of identity theft or systemic financial exclusion. If you are unemployed, a fraudulent account opened in your name could block you from getting a job that requires a background credit check. Monitoring your raw data is a non-negotiable defensive posture.
Definitely. So what does this all mean for my old accounts? If I have a starter card I hate, shouldn't I just close it? It just feels safer to have fewer open accounts out there.
No, the Experian data explicitly says that is a terrible idea. Closing old accounts is one of the most mechanically damaging mistakes you can make because it attacks two different algorithmic buckets simultaneously.
Okay, break that down for me.
First, it shrinks your total available credit. If your total combined limit across all your cards was $10,000 and you close a starter card with a $2,000 limit, you now only have $8,000 in available capacity.
Right, so if my monthly spending habits remain exactly the same, my credit utilization ratio, that massive 30% chunk, instantly spikes because I'm suddenly taking a much larger bite out of a smaller pie.
Yes. The math immediately works against your utilization ratio. Second, closing the account attacks the 15% length of credit history bucket. While a closed account in good standing does remain on your report for up to 10 years, it will eventually fall off the ledger.
And when it does, the mathematical average age of your accounts shrinks. You are quite literally throwing away the foundational anchor of your credit history.
Exactly. Unless an old card has an exorbitant monthly maintenance fee that you simply cannot justify, it is mathematically superior to keep the account open, put a tiny recurring subscription on it, set it to auto-pay, and just throw the physical plastic in a drawer.
So what does this all mean? It means your credit score is not a mystery, and it's certainly not a judgment of your moral character. It is a highly specific mathematical formula, a behavioral lockbox. And you now have the exact combination.
You know the rules of the game.
You know that 35% of your energy needs to go into paying on time every time, and 30% needs to go to keeping that RPM gauge below 30% before the statement closes. You know that graduation algorithms on secured cards, forced savings credit builder loans, and rent reporting intermediaries are your mechanical on-ramps to build that data.
And you know that unglamorous side hustles like reviewing AI hallucinations can provide the exact flexible cash flow needed to fund those tools.
And you know that defending your score means managing your statement dates and refusing to close your oldest accounts.
The system can absolutely be mastered once the mechanisms are understood. But, this raises an important question, something for you to mull over as we look beyond the 2026 landscape. The FICO score feels like an immutable law of physics, but it was only invented in 1989. As scoring algorithms constantly evolve, like we saw with FICO 9 reducing the power of authorized users, what happens when AI completely takes over risk assessment?
The goalposts are guaranteed to move.
Exactly. Right now, FICO measures your past payment history, but what if a future AI underwriting model evaluates your entire digital footprint? Could the quality of the work you do in an AI reviewer's side hustle, like your keystroke efficiency, your error rate, your client retention, could that one day become a direct factor in your actual credit score? Will your digital reputation eventually become mathematically indistinguishable from your financial reputation?
That is a wild thought to leave on. We started by talking about how the system replaced the human handshake with a 3-digit code. And eventually, a predictive AI model might just throw away the FICO code entirely and scan the entirety of your digital life. But until that day comes, you've got the exact math to the current vault. Keep your RPMs under 30, never miss a payment, and keep building.